So on the surface, this sounds like an absolute dream for American families, right? A government plan to build a savings nest egg for every single child. But what if that promise was hiding something else entirely? A brand new report from a pretty sharp AGI analyst who goes by Robo John Oliver makes a really shocking claim. It says this isn't a gift for the next generation. Nope, it's a sophisticated grift. So today, we're going to break down that report and really dig into its powerful and, frankly, pretty damning argument.
Yeah, the report kicks off with this just, wow, a real bombshell of a quote. It's brilliant, it's evil, and it's happening. I mean, that is an incredibly strong accusation. So you have to ask, what on earth could possibly justify a statement like that? Let's unpack the logic here and see what's really going on with this plan.
Okay, so first things first, the $1 million promise. To really get the critique, you have to start with how this plan is being sold to the public. And look, on the surface, it sounds absolutely incredible. A government-backed program that's designed to turn every single child into a future investor and maybe, just maybe, a millionaire.
So here's how it works, in a nutshell. It all starts with $1,000 from the government for every newborn. That's the seed money. Then, families are really encouraged to contribute with a pretty powerful tax incentive. But, and this is the part the report says is absolutely crucial, it's all about the restrictions. All of that money, every single dollar, has to be invested in U.S. equity index funds, and it's locked up tight until the kid turns 18. No bonds, no cash, no international stocks for diversification, nothing. Just U.S. stocks.
And this is the promise that grabs all the headlines. $1 million. Plus, the administration's own projections are showing that these accounts could be worth that much by the time a child hits 28. I mean, it's a super appealing vision, right? Building real generational wealth. But it's right here, at the peak of that promise, that the Robo John Oliver report just slams on the brakes. It shifts from the dream to what it calls the real problem.
See, the report argues that to understand this thing, you can't just look at the rules of the plan. No, you have to look at the timing. It claims this whole program is being launched at a moment when the U.S. stock market is, frankly, on the edge of a cliff, a moment of extreme vulnerability.
And to make its case, the report points to two key metrics that are basically flashing bright red warning lights. First, you've got the Buffett indicator. Think of it as the market's price tag compared to the whole country's economy. Well, right now, it's over double its historical average. At the same time, you have something called the Shiller P/E ratio, and it's at a level that historically has shown up right before some major market crashes. So the report's conclusion is dead simple. This plan is forcing kids to buy into the stock market at pretty much the most expensive point in history.
And this leads the report to ask a really, really fundamental question. Think about it. The stock market isn't some magic money machine, right? It's a transfer. For every single person buying a stock, there has to be someone else selling it. So, if the government is about to create this massive new army of forced buyers, who's going to be on the other side of that trade? Who, the report asks, is doing all the selling?
And that question right there, who's selling, that is the key that unlocks the report's entire central argument. It claims this plan isn't about building wealth for children at all. No, it's a mechanism, a machine, basically, for a massive, massive wealth transfer. So let's walk through exactly how the report claims this whole scam is supposed to work.
Now, to really get this, you need to understand a key financial term the report uses over and over: exit liquidity. Just think of it like a guaranteed escape hatch. Let's say you're an investor and you're holding a bunch of stuff you think is way, way overvalued. Exit liquidity is that massive, reliable river of new buyers that lets you sell everything at a super high price and just walk away with a pile of cash. It's your way out. Okay, so the report lays this out as a clear four-step process. Step 1, the government creates guaranteed demand. You've got this captive pool of buyers who have no choice. Step 2, the current wealthy stockholders start selling their shares into this new wave of demand, locking in all their profits at these peak prices. Step 3, eventually that forced buying slows down, that artificial support is gone, and the market does what it always does. It corrects back to its historical average. And finally, step 4, the kids. They're left holding the bag, owning stocks that are now worth way, way less than what they were forced to pay for them.
You see, the report argues that for those million-dollar projections to ever come true, it would require each generation to sell their stocks to the next generation at even crazier, higher prices. The source is pretty blunt here. This isn't a sustainable investment model. They call it what it is, a pyramid scheme, and it's using America's children as the base.
So look, if the report's analysis holds up, this whole thing boils down to a very simple question of winners and losers.
Who is this plan really designed to benefit, and who is the one that ultimately has to pay the price? Well, the source gives us a very, very clear breakdown.
To figure out who the sellers might be, the report just says, hey, let's look at who owns all the stocks right now. And the data is, well, it's staggering. The wealthiest 10% of American households, they own nearly 90% of all stocks. 90%. Meanwhile, the entire bottom 50% of the country owns just 1%. So the report argues when you create trillions of dollars in new forced demand for stocks, what you're really doing is creating a golden exit ramp for that top 10% to cash out.
And here it is, the alleged divide, just laid bare. On one side of the ledger, you've got the winners, the current large stockholders who get to cash out at the very top, and of course the financial services industry, who will be collecting fees on all this. And on the other side, the losers. The children buying these massively inflated assets, the working families taking on all that market risk, and let's not forget the future taxpayers who have to fund the whole thing in the first place.
But the report doesn't stop there. It doesn't see this as just some isolated policy mistake. Not at all. Instead, it frames this entire kids' savings plan as just one piece of a much larger and honestly, much more cynical pattern.
The author really starts connecting the dots here, seeing this clear pattern between the kids' savings plan, all these other inflated investment claims we see, and even unfilled tech promises like self-driving cars. The report argues the common thread is always the same. A huge, grand promise is made to the public, but the real mechanics of the deal are designed to do one thing: funnel wealth upward. The source gives this whole pattern a really chilling name: late-stage empire looting.
And according to the report, the real political genius of this plan is its timeline. The pain isn't going to be felt for decades. Think about it. The benefits for the sellers, they're immediate. But the devastating losses for the kids holding these accounts, that will become clear until the first cohort turns 18, and it won't be fully understood until they're nearly 30, long after the politicians who cooked this whole thing up are gone from the scene.
And so, the report ends on this deeply, deeply sobering note. It concludes that the plan's ultimate outcome won't be a million-dollar nest egg. No. It'll be a harsh lesson for an entire generation. A lesson where they'll learn, as the report says, who actually matters in America. And it's not them. And that just leaves us with one final question to chew on. Is this a plan for the children, or are the children just part of the plan?